how gold exchange traded funds work. Hello and welcome to yet another episode of BSC's Investor Education Awareness Series. I am Siddharth Zarabi and I'm going to tell you all about gold. Well, gold has always lived up to its reputation of being a safe haven. In this episode today, we will talk about how the gold metal can shine in your portfolio through exchange traded funds. According to the World Gold Council, gold is one of the best performing asset classes and has delivered a return of 11% as of April 2020. This shows that in times of uncertainty, market volatility, or turmoil, precious metals such as gold can be viewed as a safe asset class. But investing in physical gold can be a huge problem, especially when it comes to security as well as storage, which is why the recommendation is to invest in gold ETFs. When you invest in a gold ETF, you don't actually own any physical gold. Instead, what you hold is the cash equivalent of the price of gold. So when you sell that ETF, you do not receive the precious material in any form, but you earn the cost of the gold at the time at that point of sale. By investing in a gold ETF, you can gain exposure to the performance of the gold or its daily price movements. And because financial experts believe that gold ETFs rise when a currency goes down, if your investment portfolio has gold assets, you could use that to balance the exposure in your portfolio. You can also view sovereign gold bonds as an excellent investment option. Sovereign gold bonds are issued by the Reserve Bank of India on behalf of the Indian government. These are bonds that are denominated in gold. By investing in the Government of India's sovereign gold bond scheme, you stand to benefit from, number one, an attractive interest rate with an opportunity of appreciation. You can redeem it at current gold prices. You also eliminate the risk and cost of storage. And if you hold it till maturity, a sovereign gold bond is also exempt from capital gains tax. Remember that. With a sound understanding of how gold ETFs work, you could find it to be a lucrative investment opportunity and benefit in the long run. And before we leave, here is a word of advice on gold ETFs from an expert. Take a look.
So ETFs, to expand the term, it's called exchange traded fund. It's very similar to an index fund. The difference between an index fund and an ETF is that an ETF exactly buys the share in the relevant index. So an ETF is always related to an index. So when they buy that, they buy it in exact. So the tracking error that I mentioned in index funds is very, very minimal in ETFs. That's one. They are also low cost products. So what is a gold ETF? So the gold ETF helps you invest in gold in the form of paper gold. What do I mean by paper gold? All of us, I think, being Indians, do have an exposure to gold in our lives, either from gold bought by our parents and grandparents and bequeathed to us, or because you bought that piece of jewelry that your spouse liked, and either it's a ring or a necklace that you have. And third is that we all see, and when we go into televisions and you see the markets, you see gold prices rising, you say, why not I buy? And we may go buy gold jewelry just for the purpose of a long-term investment or for the purpose of through gold nuggets as a pure investment. Gold ETFs give you a much simpler, much more cost-effective methodology of acquiring gold, because this gold ETFs are also run by mutual funds and other agencies. So what they do is they buy the gold on your behalf and they store it in lockers. So you don't have to physically deal with the gold. So first, the inconvenience and handling those gold nuggets, finding a space to store them, all that is out of the question for you. Second is that when you buy gold and sell gold, right, very often in the jewelry business, there is what is known as making charges and wastage, which is protected. Not only that, there's a selling price and a buying price. So you may go to a jeweler and buy the gold in the morning, the same jewelry in the evening, if you want to resell it back to him, there will be a cost to you, a loss to you, because the buying price and the selling price are different. All of these problems can be avoided and minimized by investing in gold through gold ETFs, which is a paper gold, which you can buy at any time, sell at any time. You get the gold price differential into your account, and hence, as an investment option, gold ETFs make far better sense than buying gold jewelry or gold nuggets.